In the video today, myself and my colleague Devon Card will be discussing the importance of doing a liquidity analysis in terms of your estate plan. The first instance to understand about liquidity analysis is that the purpose of that is to ensure that you have sufficient liquid assets in your deceased estate to be able to pay all the costs, expenses, maintenance orders, as well as any other specific bequests that an individual would like to have within his deceased estate. The first step to understand when doing such an analysis is determining which assets forms part of the estate and what the nature of those assets are. Part of that analysis also would need to be to look at what type of marital regime the parties were married with, because that has an important bearing on which assets forms part of the estate. As an example, someone married COP only has half a 50% undivided interest in all of the assets made up in the joint estate, whereas someone married alimony of property with accrual might have a specific accrual claim that could be lodged against the estate and therefore increasing the expenses or liabilities within the estate. When looking at your estate, always look at the type of assets, so whether you have fixed assets such as fixed properties, cars, etc., or whether your assets are intangible like unit trusts, bank accounts, or any share investments.
In calculating the estate costs and liabilities, a very important factor to remember is that SARS has the first claim on your estate. And what this basically means is that any tax owing first needs to be paid to SARS before any of your heirs or beneficiaries can receive their inheritance. The tax liability with SARS is broken up into two parts. So one, it is all taxes owing up until the point of death, and then any taxes owing from the date of death up until the final sign-off of the liquidation and distribution account. Another factor to remember, just diving down into some of the taxes that are payable, is that death is actually a capital gains event. And what this basically means is that when you pass away, you're deemed to have disposed of all your assets at a relevant market value. So following on to practically how it would work, after the executor submits the pre-death tax assessment, they will then need to submit a post-death tax assessment that would obviously include any capital gains tax applicable, and it would need to be declared in this post-death tax assessment. Now, while it probably sounds like passing away and winding up the estate just includes paying a lot of taxes, it is important to remember that there are certain assets that are excluded from capital gains tax, mainly assets that are left to your surviving spouse, majority of your personal use assets, any assets that are bequeathed to a public benefit organization, as well as any life insurance policy payouts. As the law stands right now though, in the year of death, individuals are given a 300,000 Rand abatement on capital gains tax. Basically what that means is that the first 300,000 of gain in the year of death is exempt from tax.
Some of the other costs and expenses that can also be included in a liquidity analysis would be your last medical expenses and hospital costs that was incurred prior to death. Another big cost that needs to be taken into account is that of executors' fees. That's the fee paid to the person who winds up the estate, and that could be up to 3.5% of your gross asset value of the estate. So that is definitely a considerable amount that you need to determine and understand how that would be able to be paid by the deceased estate. Further costs that could be incurred would be in the event of a fixed property that needs to be transferred. The attorney doing the transfer of that asset would need to be charged a transfer fee. Additional costs if the property needs to be sold could be agents' commissions, bond cancellation costs, and other various costs related to the sale of the fixed property.
So once you've calculated the net value of your estate, you now need to determine whether your estate is going to be liable for estate duty. It's important to remember that all individuals in the event of death do have a 3.5 million Rand estate duty abatement, and any asset value over and above the 3.5 million Rand including all your global assets, will be subject to estate duty at a rate of 20% up to a value of 30 million rand, and thereafter 25% for anything over and above 30 million rand. In determining the estate duty, remember that there are some assets that will be excluded from this calculation, like any bequests made to your surviving spouse, any bequests made to public benefit organizations, certain business assurance policies, and any insurance policies where you have made the beneficiary your spouse as well. If you own foreign assets, it is important just to take careful care and consideration in determining the tax laws around the various jurisdictions those assets might sit in, and if there are dual tax agreements between the jurisdictions of the country where those assets lie and the country you currently are a tax resident in. Something that's also important to take into consideration when it comes to estate duty, remember that estate duty is payable from the residue of your estate. So what we need to consider is if there are any special bequests made in your will. It's just to understand the flow of how the liabilities are paid in the estate. So basically what that means, if you have made special bequests, those would be paid to your legatees and included in the estate duty calculation, and then estate duty would be paid from the residue. And simply put, if you have any beneficiary or if you have any heirs who are then due an inheritance, this flow of liabilities could greatly reduce their overall inheritance.
The last thing to consider when looking at liquidity within your estate is the time that it could take to wind up the estate. The reason why this is important is that during this period, things like debit orders, your normal cost, insurance and bond payments will still be required to be settled, and it's important to understand that sufficient cash would be available to your dependents to carry them through this period. Therefore, it's important to sit with your financial planner and carefully consider all these considerations, costs, etc., and plan sufficient cash flow to enable them to get through this difficult period.